Kotak E-Vest Plan. Will investing in this plan help in your wealth accumulation process and build a financially secure future for your family or not? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decisions to reach your financial goals in a faster and smarter way. So before analyzing Kotak E-Invest Plan, let us first understand what is the Kotak E-Invest Plan. It is an individual, unit-linked, non-participating endowment life insurance plan, and some of its key features are it has 100% allocation given to your premiums. Also, there are yearly additions starting from the end of your 6th policy year onwards till maturity or death, whichever is earlier based on the plan option you have chosen. Also, 25% to 200% of your life cover charges which are deducted will be then added to your fund value later on if it is applicable to your situation. Also, it provides you with the flexibility to choose from 2 investment strategies. And there are options of adding additional protection through optional riders. There are 3 plan options available under this plan, which are Maximizer, Rising Star and the Retire Rich. So let us first take a look at the benefits available under the Kotak E-Invest Plan. First, let's take a look at the death benefit. Death benefit simply means that if the policyholder unfortunately passes away before the policy term ends, then the nominee of the policyholder will be able to get a death benefit from the Kotak E-Invest policy. So how the death benefit will be determined will be according for the plan option, Maximizer or Retire Rich plan option. You can see that there are 3 options given as death benefit. So out of these in the screen, whichever option's value is highest at the time of date of death of the policyholder will be given as the death benefit to the nominee. And for the Rising Star option, you can see different options given in the screen. You can simply pause the screen and take a look at the options given. So next we are going to take a look at the maturity benefit. For all the plan options, Maximizer or Retire Rich or Rising Star, the fund value which is on the date of maturity of the policy, including of the ROMC and yearly additions, will be payable as the maturity benefit under the plan option of Maximizer and Retire Rich. But in the case of Retire Rich option, it will be only paid as a lump sum option. You cannot get it through installment option, unlike in the plan option of Maximizer or Rising Star. In the case of Rising Star, also the fund value on the date of maturity of the policy will be paid as the maturity benefit, but it will be paid regardless of the survival of the life insured as long as the due premiums have been paid till the date of death. Also, there are yearly additions which starts from the 6th policy year till maturity or death, whichever comes earlier. So 3% of your annual premium is infused into the fund at the end of each policy year. So these are some of the benefits we get by investing in this policy. Also, I have forgot to mention that there is a return of mortality charges, ROMC, which is deducted throughout your policy term from in respect of your life cover, which will be later on added back to your fund value based on the policy term you have chosen. So you can consider these factors and benefits available under this plan to decide whether investing in the Kotak E-Invest will be suitable for you in the long term or not. Now let's take a look at the investment strategies and the fund options available under the Kotak E-Invest Plan. So there are 2 investment strategies. First, you are going to take a look at the self-managed strategy. Under this strategy, there are a lot of power-packed fund options that can enable you to maximize your earning potential in the long run. So you can see that there are funds ranging from equity, debt, money market, for which their risk profile ranges from aggressive to moderate to conservative to secure. So based on your risk tolerance, you can choose which of the fund options you want to invest in. So this is one kind of strategy. Another one is the age-based strategy where the allocation is already chosen based on the age and risk appetite. So based on the risk appetite of the customer, aggressive or moderate and conservative, the allocation is done between classic opportunities fund and dynamic bond fund. On every monthly policy anniversary of your policy, they will rebalance the units so it can achieve the given proportions of the fund value in the identified funds. So this is another kind of strategy. So whichever investment strategy and fund options you feel comfortable to invest in, you can choose to invest in that. So now we are going to take a look at the charges that we might have to pay while being invested under the Kotak e-Invest plan. There is no premium allocation charge which is usually charged for entering the policy. And there is a policy administration charge which is a charge for staying committed to investing in this policy, which is a charge for at 400 rupees per annum to recover the monthly cancellation of units. And this charge is applicable until the end of your policy term. There is also a fund management charge which ranges from 0.5% to 1.35% depending on the fund options you have chosen to invest in. There is also switching charge which is free for or up to 12 switches in a policy here, but for every additional switch thereafter you will be charged 250 rupees. Then there is the partial withdrawal charge. So the first 4 partial withdrawals are free in this plan, and thereafter whichever partial withdrawal you do after that will be charged at 250 rupees. And there is a discontinuance charge which is based on which year you discontinue and the premium amount you choose to pay in this policy. There is also mortality charge which is you have to pay for them giving you the life cover. So for a life cover purpose you are going to pay mortality charge. And there is also a miscellaneous charge which is usually charged for the replacement of your policy document or check dishonor, which is 250 rupees per request. Or if you want to redirect your premium, there is also a charge of 100 rupees. So these charges are usually present in all ULIP plans, but these the charges under the Kotak e-Invest plan seems to be a little bit higher on the expensive side. Also, these charges usually place a significant burden on the investors because these charges they will not deduct it from your gains. What they will do is they will get your premium, then they will deduct these charges, and then they will invest the remaining amount in the fund options you have chosen to invest. So the principal amount you're thinking of investing is not getting invested here. The charges are not deducted from the gains you might get from the fund options you have invested. What they have doing is they're already deducting from your principal amount, your premium amount. So what happens is in the long run, it impacts the overall return you might get from this policy. That's why charges usually place a significant burden on the investor. So you need to consider these factors before choosing to invest. Let's take a look at the advantages of Kotak e-Invest plan. So through the settlement option, the policyholder have the option of taking their maturity proceeds either as a lump sum or through pre-selected periodic installments. This settlement option is not available under the Richie Rich plan option. Also, you can have your retirement income along with income booster attempts. Also, there is a Rising Star plan option which offers you a triple protection benefit on your parents' death through lump sum payment, monthly income and policy continuation till maturity. If you have chosen the Retire Rich option, the policy cover is till the age of 99 years. So what are the disadvantages of Kotak e-Invest plan? There is no loan option available under the Kotak e-Invest plan, and it also does not offer you with any liquidity during the first 5 years of the policy here. The sum assured offered in this policy is too low to cover the basic needs of the policy, which makes us doubt if it will help us create a financially secure future for our family in the long run or not. So you need to consider these factors before choosing to invest in the Kotak e-Invest plan. Let us move to the main part of the analysis of the Kotak e-Invest plan, which is the IRR analysis. IRR means the internal rate of return. No matter the benefits and advantages we get by investing in a plan, we need to understand what is the IRR we get at the end of the day, because the IRR is more important because that's the return we get in a hand, right? So now we are going to analyze the IRR of this policy. So to analyze it, we are now going to assume that a 35-year-old male has invested in this policy for a sum assured of 15 lakhs, and the policy term and the premium paying term are 15 years, and the annual premium for this policy is 1.5 lakhs. So based on the website calculator they have given in the Kotak website. We have calculated according to the figures mentioned in their policy brochure. So we have chosen the maximizer option to calculate because it has the wealth creation variant. Now, as this is a market related instrument, we are going to assume the IRR based on two calculations. One, and the worst case scenario, which is at the 4% per annum, and in the best case scenario, which is at the 8% per annum. Both these calculations are not guaranteed and only for example purposes. So at 4%, it gives you a IRR return of 2.67%, and at 8%, it gives you IRR return of 6.54%. In both the percents, you can see that in 2.67%, it is giving you a return of which is comparable to the rate of interest of a savings bank account. Because if you do not invest anyway and you just keep your money in a savings bank account, it will still give you a similar return like this. So what is the purpose of taking the risk of investing in a market related instrument and investing in such amount of time and effort only to get a return like this? And it's not even guaranteed, it can even go lower than this. So if you choose to see the best case scenario IRR return, it's giving you 6.54%, which is similar to the returns you might get from a debt instrument like fixed deposit FD. But this is an return risk related instrument, right? Why do we choose to invest in risky instruments? So in long run we can maximize our potential returns. But if we are getting a return which is similar to a debt return, which is at least guaranteed, but here it's not even a guaranteed return, then what is the purpose of investing here? So from the returns IRR analysis, we can see that both the scenarios, it's not giving us a justifiable return, and it's clear that it will not help us with a wealth accumulation process to create a financially secure future for our family. So it's doubtful whether this will help us, right? So now let us compare Kotak e-invest plan with other investment products available in the market to see if it can give us better returns compared to Kotak e-invest plan if we invest the same amount of risk, time and money into these products. So how we are going to invest here is we are going to invest in a combination of pure term policy plus ELSS or PPF. We have chosen a risk-free product like PPF, which is a public provident fund, which is a government-backed product, which can give you guaranteed returns, and also there is tax benefit under section 80C. And we are also choosing to invest in ELSS mutual funds, which has a consistent track record of more than for many years, which has shown us that if we invest in it for more than 7 to 10 years, it can give us returns up to 12%. So based on that calculation, we are calculating the returns for both these products. Why we are choosing to invest in a combination is we are not going to invest in a policy like investment cum insurance policy. We all have separated the life cover and investment from our investment. So we have chosen a pure term insurance policy for the life cover purpose with the same sum assured of 15 lakhs like the Kotak e-invest plan, but with a affordable premium of 7,100 rupees per annum, with a policy term and premium payment term of 15 years, and the remaining amount of 1.42 lakhs will be invested annually in the other investment products we have chosen to invest. So the 1,42,900 will be invested in a PPF and also in ELSS. So in both these combinations, let us see what kind of returns we will get. In the PPF, we get a return of 6.54%. And in the ELSS combination, we get a return of 10.73%. The PPF combination gives you a similar return as the Kotak e-invest plan best case scenario. But here the difference is this is a guaranteed return. So 6.54% is a decent return for the amount of time we have invested. And also it's a guaranteed return which is not available in the Kotak e-invest plan. But here, ELSS mutual fund, we are taking the same amount of risk and we are investing so much, and still we are getting a 10.73% in the long run. 10.73% with an amount of 55 lakhs. Actually, we are getting a 59 lakhs as the pre-tax value, but after the tax, paying the tax, we are getting a value of 55 lakhs for an IRR of 10.73%. which is definitely an inflation beating return and a risk adjusted return. In the long run, it will definitely help us to achieve our financial goals and will help us to create a financially secure future for our family. So, what is the final verdict? Should we invest in the Kotak e-invest plan or not? Is it worth investing or not? As we can see from the IRR analysis, the IRR falls short of our expectations, and also the hefty charges and the high agent commissions definitely impact the overall return we might get from investing in this policy. So, as the IRR is not justifiable, it is good to be avoided. This policy is not something suitable to invest to create a financially secure future for us. So, if you want to invest in something that can give you a financially secure future with a inflation beating return, you can definitely choose to invest in instruments like PPF or in ELSS. Especially diversify your investment. Don't invest in an insurance investment policy. Always keep your insurance and your life cover separate. You can choose a pure term insurance policy for an affordable premium for a higher coverage, and also choose to diversify your investment through various asset classes. So, if you still have any doubts regarding which one to invest according to your financial goals, you can also involve a professional certified financial planner in the whole investment process, so they can keep the investment journey smoother for you, because as a professional they will know which factor to consider, which funds to invest, and they will personalize a financial plan and investment strategy for you. So involving a professional in the long run is always a wise move. If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.